Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Wednesday, October the 16th, the year's 2024. Let's talk trading. Gun to your head trading, part 4. Yeah, yesterday the screen said part 4, but it was really part 3. As always, these videos are for educational purposes only. Your results may differ from mine. And a friendly reminder about risk management. Never lose more than you're willing to lose on any one single trade. You know, that's one of the things where I keep getting emails from traders or comments. It's like, my plan, I'm losing. You know, what do I do? So I turn my plan into a winning plan. Well, the thing is, you're looking at the results, which of course is, you know, what is the reason you're trading. But the thing is, are you really sticking to a plan? I mean, is your plan solid in the sense that it has all the elements? Or are you trying to rig your plan or curve fit your plan so you'll be driving a Lamborghini by sometime next year? I mean, you just have to kind of be realistic. Um, you know, and the thing is, sometimes it's easy to be right in the short term. Sometimes it's easy to be right in the long term. So you have to see, how good are you? How good are you in determining which way price is going to go for the next, 2 minutes, 3 minutes, 5 minutes, 10 minutes, 30 minutes, hour, 4 hours, today. I mean, just how good are you at that? I mean, take a look at this chart. Now, you can call this hairy hindsight if you like, but we're using the big range bar indicator here, and you see price drop down, and then you see price just came right back to it. I mean, yeah, you could have maybe jumped in here, and then you would have been, maybe you would have hit your stop. I don't know. But you see, price came all the way down here. Now, I had mentioned, I don't know, a few weeks ago, there's an old trick that some traders use. And when you get one of these big bars, you look at its range. And so for here, we had a high of 22, a low of 16. That's 6 pips. So if you extend that from 16, if you go down another 6 pips, that would be down to 10. Let's go down to 10. Now, look where price got near. Price got near that level right here. You see that? So, what do? Well, one thing you can do is you can sit on your hands or you can actively trade it. But if you actively trade it, you have to recognize that there's a possibility it's going to keep dropping down about the same distance that it moved. Now, some traders, instead of going from high to low, they might take the candle body and do it. And if you did, that would have been less than 6. So it definitely would have hit that area. So, for example, you see that big move, you see a flip-flop box coming. Well, because of this, maybe you only go for a pip or two, or any sign of weakness. You're in the trade, then you're out. And then you see what's happening here. Lower lows, lower lows. I mean, you see a flip-flop. But the other thing is, did this drop below the low and then close above it? No, it didn't. So maybe you don't take that trade. That's just one of those filters. And in this case, the low was below, but the close was above. So maybe you take that trade. Now let's see. Here again, the low was below, it closed above. Maybe you take that trade, you get in, maybe you pick up a pip or two. Then here, it went down below that low. It did close above it. Maybe you jump in, or maybe you take a flip-flop. So it's just little things like that. But you see, that's something that you might have to put in your trading plan. Say, here's the conditions. I look for a big range bar. I believe price is going to go back to the opening of the big range bar. And then you say, okay, I look for turn trades, but I filter it because I want to make sure that the low went below the previous low, but it closed above. You know, that's one way you could do it. You know, gun to your head trading. You see these areas, those are imbalances. Once again, price usually comes back to an imbalance. And so what the market structure traders usually do is they wait for price to come back to an imbalance, then they get back in. But they don't do it on the 1 minute. They're more likely to do it, say, on the H1. And, wow, I guess we had news, some kind of news somewhere. It wasn't good for the pound, that's for sure. And then maybe you do something like that, or maybe you even go as high as H4. Or you might even look at the daily. And, you know, once again, what happened here? Price came down near that imbalance. And then once again, you know, I'm really thinking about renaming this indicator look left, because if you look left, what happened here? Price bounced. What happened? Price penetrated, came back through, closed above, or is closing above, because this is a daily chart. You know, if you drop down to H4, you see that level right there? That's what happened. You know, you can look at the week, you're in the imbalance. And it looks like we're in that lower wick zone. See, yesterday I think we were in it. Now today we penetrated through it. Looking at that daily. And I do believe I had mentioned something about that yesterday. You know, once again, you got this huge imbalance here. Obviously, that's a big range bar. Same on the 15. But on the 5, I'm only looking at the last 10 bars with this indicator. I updated it to show how many bars you're processing. But that's huge. And then, you know, once again, you look left, you can see how there's, in this level from about here to here, you don't even need an indicator. That's a range right here. It broke out of that range once, broke out of that range a second time. Now it's doing it, it's breaking out a third time. Sometimes history repeats itself. So, you know, you're trading, but is your method really designed for, you know, 10 pip trades, 20 pip trades, 30 pip trades? Is it really going to give the opportunity for you to collect those pips? I mean, if you're looking at a 1 minute chart or 5 minute chart, even though price is the same on all charts, you know, you're going to see all this movement on the chart. I mean, if you're using a daily chart, you only see the one bar, but within that bar, look at all that movement, all that price travel. And so depending on where you enter, you might not get the benefit of it. And once again, when you look at the entry, what entry is going to give you the most pips in a day? Now, is this a trick question? Well, if you think about it, or what entry is most likely to give you the most pips? It would be trading away from the open, because price has to range, and it ranges from the open, open to high, open to low. Now you say, well, if you got in at the low and it turned around and went up and made a new high, yes, but you don't know where that low is. That's why we have the rat trade. So yeah, you could get in a rat zone trade and you have the potential of making the most pips, but every day, try that open crossover. And look at the week. Once again, the weekly open crossover. Let's see. Do I have... I'm not sure. Right here. Kind of proves my point. There's that weekly open. That's where you can make some huge pips. Does it cross every day? No. Sometimes it puts it in on Monday and price never sees the weekly open. But gun to your head, if the opportunity arises, that's what I would look for. I mean, once again, people could say, oh, that's hairy hindsight. But the thing is, it happens pretty much every day. These types of, not the weekly open trade, but these horizontal line trades that I talk about, or previous midpoint. I mean, that used to be my bread and butter trade. To tell you the truth, sometimes I question my sanity for moving away from it. But it's just, you sit down in front of the screen and you start to see things or observe things, and your subconscious then tells you things. And it's like, oh, that's a possibility. That's a possibility. But that previous daily midpoint was really strong, using it as a bias, using it as an entry level. I mean, it's kind of similar to the pivot. And you can see here, price near S1 long. I mean, for traders who are struggling, once again, maybe your PIP target, in other words, the number of pips you're trying to make per trade is too high. And there's something else you have to look at when you're looking at these trades. If price is going up, it's going up. So price is going up, but then if it starts coming back down, where do you say price is going up? Well, do you say it's going up here, or do you say it's going up when it crosses this level? I want you to think about that. And we might revisit that. But that's because if you say, well, price is going up, well, but then price is going down, but now price is going up, but now price is going down. But is it really going up here, or does it have to reach this level to continue? You put in a new low, then it reached this level, continued, reached this level, continued. Now price is going up. You might say prices, we say price goes up, price goes down, doesn't go sideways, but maybe price is really undecided and it's just oscillating. So, fellow traders, that just goes to show it's not what you trade, It's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.